Made in China. Those three words appear on everything from computers to toys to massive industrial parts. But behind those three words is a history of forced labor, human rights abuses, and stolen trade secrets. As democratic countries rally behind the call for freedom and holding the Chinese Communist regime accountable for its human rights atrocities, are consumers going to see less made-in-China products going forward? In this special report, we look at what China's 2022 economic outlook means for companies trying to do business in China.
I'm just kidding.
For investors weighing the risks, and how the average Joe at home could be impacted without even realizing it. Welcome to China in Focus. I'm Tiffany Meyer. With a potential war brewing on the horizon, continued lockdowns, and Beijing's upcoming Winter Olympics steeped in controversy, 2022 is off to a rocky start, and it's only promising more.
The world economy is going to continue to suffer.
But what do all these events mean for China's 2022 economic outlook? And have the impacts already rippled into global markets and influenced consumers?
Anyone who's invested in Chinese tech stocks in the past year has been very disappointed.
Under China's harsh pandemic measures, massive lockdowns left factories empty, supply chains stalled. At the same time, thousands of miles away in America, the pandemic led to an increase in consumer spending, most of those goods coming from China.
The American consumer has been on a binge buying Chinese products.
But China couldn't meet the demand.
The global supply chain has shown weaknesses over the past 2 years.
Consumers around the world met with empty shelves, unable to find what they needed, from daily necessities to face masks and ventilators. That all traces back to global manufacturing, and China is known as the world's factory. Since joining the World Trade Organization in 2001, China has exploded in influence on the global stage, snagging the title of the world's factory. 28% of global manufacturing comes out of China. That's nearly as much as America, Japan, and Germany combined. Those numbers come from accounting firm Global Upside in 2019. China has been able to do that thanks to low labor costs, low taxes, and lack of regulatory compliance, to name just a few. But the pandemic threw a wrench into that system. To combat virus spread, China took an approach known as zero COVID policy, which meant strict lockdowns and mass testing anytime so much as a single case popped up. And with workers staying at home, factories were left empty.
We're still seeing significant backups in the ports of Los Angeles. We're seeing significant delays out of China. That's going to be a major issue going forward.
Despite the massive lockdown sweeping across the country, China's status as the world's factory seems intact.
It is the world's factory, and it's very big.
But as we head into this new year, something does seem to be changing.
There's an increasing movement in the U.S. to bring production back to the U.S. or to move it out of China.
CLYDE PRESTOWITZ, president of the Economic Strategy Institute, notes some might call it a division of supply lines.
For instance, companies want to be able to say, if I'm selling to the American market, if I'm a computer company that might be selling computers to the U.S. government, I need to have those computers made in India. I need to have those computers made in Mexico, which is a trusted partner of the U.S. government.
But David Goldman, deputy editor at Asia Times, doesn't see that happening.
And as long as that occurs, if people want electronics, and Tim Cook of Apple Computer says he can't build a smartphone in the United States, Americans will keep buying Chinese products, despite the fact that the sentiment against China is certainly more negative than it ever has been. But if you want a computer and it's made in China and you can't get a computer made in the United States, you'll buy a Chinese computer.
But the pandemic isn't the only major issue. Another one rearing its head is politics.
On top of that, I think there's an increasing disconnect between the values and and the expected behavior, companies and leaders who are engaged with China and also with the outside world. So,
as part of its Top Risks 2022 report, political risk consultancy Eurasia Group says the Beijing Winter Olympics is highlighting a danger facing companies caught in the middle. The report notes a two-way risk. On one hand, if a company speaks out against forced labor and human rights issues in China, it faces fury from Chinese regulators and consumers. But if it doesn't, it faces backlash from regulators and consumers in the West. Companies are now finding it harder and harder to do business there and trying to please not only China, but also the democracies in the West.
Most companies are probably having their PR reps hang by the phone and hope that it doesn't ring.
The U.S. recently passed a law banning importers from sourcing goods from Xinjiang. That's over China's genocide against the Uyghur ethnic minority in the region. Companies soon found themselves stuck in the middle between bringing in profit and upholding their values. Walmart stopped importing goods from Xinjiang, only to immediately feel Beijing's wrath. On the flip side, Elon Musk just opened a Tesla showroom in Xinjiang. But for some, they might not even know their values are being betrayed.
More and more free world executives and major corporations are going to be faced increasingly with this contradiction between wanting to do business in China, but in order to do business in China, they have to betray their own values.
Those people are school teachers, firefighters, or even government employees. And as a result of that system,
most people probably don't even realize they're invested in Chinese firms. And most of that money is coming through what we call passive flow. And basically a passive flow is your pension fund, your mutual fund that you buy automatically, for instance, formulaically sends $5 to China. And then of that $5, every penny is equally distributed between all the companies allowed to invest. So there's no differentiation.
Despite those risks, China's massive population of 1.4 billion makes it highly desirable for companies to get in on the action and profit through the Chinese market. But it's tricky doing business in China. Christopher Balding, Senior Fellow at the Henry Jackson Society, has over a decade of experience living and working in China and Vietnam. He notes the delicate dance of navigating China's unwritten rules.
I'll give you just one example. There was an entire cottage industry. When you filed your incorporation papers to start a business in China, you had to declare, you had to show proof that your company had a bank account with X amount of money in it. But you couldn't open a bank account under a corporate name without the registration papers. So you were in a catch-22.
It seems it's not just U.S. companies caught in the middle. Chinese companies are also dealing with a double-edged sword. On one end, there's the potential for triggering the communist regime's wrath. And on the other,
the Securities and Exchange Commission in the United States is making demands on Chinese companies to be as transparent as American companies in their accounting and reporting, which of course they aren't. Chinese reporting standards are far more opaque and unreliable.
Examples is that Didi, the ride-sharing company in China, they were in business for, I think, about 4 to 5 years, processing millions of rides a day before they got their official business license in Beijing.
Beijing is known to leverage business licenses over its own companies, wielding the power to give or take them away at will.
And so this gives the government enormous authority to control businesses because a business can basically be shown that they've broken the law almost at any time.
Didi made headlines for several reasons. First, for raising a record $4.4 billion through its IPO, when it listed on the New York Stock Exchange in June of last year. But as a ride-hail company, Didi has the potential to collect and store massive amounts of data, including on the Chinese Communist Party's leaders. That's as Didi's rideshare cars transport officials to and from government buildings, while its GPS systems record where, when, and how often. Out of fear that such details could find their way to the U.S., the Chinese regime clamped down on the company.
So effectively, it was forced out of the U.S. market.
So what are Chinese companies to do? Many are moving out. The companies
delists in America and relists in Hong Kong.
Now, for investing, risk is the name of the game. But is China getting too risky to invest in?